I want to pivot to Amanda. And Amanda, firstly, I deeply, deeply appreciate you being here. It's very late in the evening there, 11:40 in California. So thank you so much. Mag Capital Partners is someone that we've worked with for a long time. And what's super interesting is that they've specialized in industrial property. And what is really interesting for me with regards to Mag is that we've done a couple of deals with them, and they've been our best performing, probably ever, our best performing partner, where all the deals have worked, all the deals continue to pay, regularly, etc. In terms of the process. Yes, there was a challenge with moving money between Mag and getting into Lemonway, but that had nothing to do with the deals. And the deals have literally paid on time, regularly, etc. So it's with a huge amount of excitement, Amanda, that we have you here today to share with us around not only who is Mag, why industrial, and the pipeline of opportunities that are coming. So I know that everyone always says to us, Scott, we need more deals. So we listen. So Amanda, thanks for being here. I really appreciate it.
Yeah, thank you so much for having me here. Can you see me? Oh, there you go.
Yeah, we got you. Yeah.
Thank you. I appreciate it. Thank you for waking up this morning and being with me. I have a presentation for you where I will go through a little bit about MAG, who we are, what we do, more details about the industrial real estate in the U.S. market. Actually, it's probably beneficial that you already had the presentation prior on some U.S. market things that are happening, but this is, solely U.S. based commercial real estate. And then I will talk a bit about some of the investments that we have. Just to start out with our pipeline, we have a pipeline that is, continuing to evolve and grow. So I can talk about a couple of the investments that we have available right now. And then as we have more investments that are coming available, I've told Scott that I'll share those ahead of those investments being available so that I can let you all know and provide you all information and maybe even get on another call with you to discuss those. We'll decide what's best and how best to go forward with that. But let me share my screen.
Just while you're sharing the screen, I'll put up the survey for people. It should be a separate survey while the screen's up. But anyway, it's there. There's no rush. I'll leave it open for the rest of the session.
All right, let me slideshow this one. Can you see my screen?
Yeah, we got you loud and clear. Thank you. And nice. Yeah, it's all big screen.
Perfect. So we are MAG Capital Partners. We're a commercial real estate investment group. Of course, we start with our disclaimer. You are investing in commercial real estate at your own risk. I have this disclaimer for you if you would like to look closer at it. But again, all it says is that when you are investing in commercial real estate, you're investing your own money, and there is some risk to that. But as Scott had said, we try to mitigate that, and we have a very good track record. We are a commercial real estate investment group that focuses mainly on industrial real estate. With that being said, we do occasionally have some investment opportunities that are outside of industrial. In the past, we've had some multifamily. We have some debt opportunities. We are getting into the multi-tenant industrial space. But our bread and butter, our real true expertise is in the single tenant net lease industrial. And without knowing exactly what everybody knows about industrial real estate in the US market, I'll get into a lot of detail. And if you have any questions, please, stop me and ask questions, or we can save questions for the end, whatever works best for you.
Cool. So my recommendation, Amanda, is if people have questions, just type them in the chat box or raise your hand. And if it's relevant to the specific, then we can deal with it there. Otherwise, we'll ask it at the end to keep you with your flow.
Yeah, great. And let me know if there's any questions, and you can read those off to me, Scott, and you can tell me.
Don't worry, I'll fly the airplane. We're all good.
Perfect. Thank you so much. I appreciate it. Yeah, so we're like I said, talking about industrial net lease real estate, and this is all sale leaseback. And so what we're doing is we're acquiring real estate, all U.S. manufacturing. And we are placing long-term leases. A majority of these companies have been in business, maybe 30 to 50 years. They're not mom and pop, maybe they're family owned. They have, a real strong niche in an industrial market, and they have, weathered multiple, financial storms, let's say. So they are established businesses. They're not publicly traded. So we in-house have a credit team that looks very deeply at the credit of these tenants. And so what we're doing essentially on a high level, and then I'll get into some detail, is that we're placing long-term leases. These are all 15 to 20-year leases at least, some more. And these are all absolute triple net leases. And when we're talking about absolute triple net leases, what that means is that the lease itself establishes that the tenant pays for everything. They pay for the maintenance, upkeep, taxes, the building itself, and the land around it. So essentially, we have a fully performing tenant from day one. We have no expenses, and we're able to, generate revenue in a variety of different ways, which I'll go through. Our properties are located all across the United States of America. And I have a chart in a second that shows you, exactly what states and where, but we really are looking coast to coast. We are looking at about 6 to 8% current yield. Some of our investments, 8 to 10% are it's a preferred return, 12% for some. So it really is deal specific on what that is. But current yield, meaning what we're paying out currently, is 6 to 8%. We have an industrial fund, and that is going to be our established fund, the main fund that we have available. We are growing into an evergreen fund, which will be really exciting for me to be able to share that information with you. We are looking at launching that in about Q2. So as that gets closer, then we will be able to offer or provide more information to you on that. But all of the properties in that evergreen fund will be exactly the same properties that we are going to be discussing today. So same type of properties, just a different structure. Our track record, we have been in business, over 10 years. We have, $1.5 billion in assets under management total, $450 million in assets under management currently right now. And we have about a 17.5% net realized IRR historically. This is our team.
Sorry, just quickly, Amanda, that's quite important. So just to be clear, when we look at someone's track record, that's really important. And for me, that's the one thing about MAG, is that you guys have consistently got the results and over a long period of time. So 17.5% is definitely above average, just for everyone to understand.
Yeah, most definitely, for sure. And when we target IRRs, we're looking at about 15 to 17%. So, what we're saying is that we really typically will return higher than that. So in our team, we are unique because we have, pretty much everything covered in-house. We have a construction manager on staff. We have a credit team. We have an acquisitions team. We have a full accounting team, tax person, which, is not as important for you guys because it will be a little bit different with taxes, but our principals and our commercial or our capital markets team, which is what I'm in. So this chart shows a lot of the states that we are investing in. And what's interesting about this chart, if you can see, is that with industrial real estate, what you'll see is that mainly it's mostly located from Texas at the Midwest over the Rust Belt. It's kind of like what that L shape looks a little bit like. We do have some properties that go, span coast to coast. We have a lobster processing facility in Maine is what you'll see farthest over. Some properties in California as well, which is where I'm located. But typically what you're going to see is that these properties are located, close to some sort of transportation corridor, whether that be shipping, rail, trucking. It's typically going to be here in the Midwest. As well, what we're looking at is secondary markets, meaning we're looking at not primary, main city centers. We're looking at those areas that are just outside of the city centers where you still have access to the main city, but you have a little bit lower prices in those secondary markets. Some tertiary markets, that means that we're looking a little bit further out than the secondary market. And we have some of those that are performing very, very well because we have great cap rates, really great prices on the real estate. And the town more or less is revolved around this business. So very interesting when you look at what these businesses are, where they're located, and really what their business does. And I can go over a few of those. It's important as well to recognize down below our tenant default rate, and that's a lot of what Scott says, that we consistently are performing and returning. Our default rate is extremely low. Our credit team, like I said, they go deeply into the credit of the tenants to make sure that they are performing. And really, the one default that we have is from a company who had to claim bankruptcy because of a terrible accident. So another story for another time, but it was a situation that was kind of out of our control. These are our principals. So Dax Mitchell and Andrew G, they got together in 2015, started investing in medical office buildings, and then transitioned pretty quickly to industrial, realizing that it's a great asset class. They both came from real estate. Dax was a commercial real estate broker. Andrew was a commercial real estate appraiser. And they, like I said, got together, brought in investors from friends and family, and then grew to where we are now, which is a really impressive operation in the last 10 years. Neil Walgren joined in 2019 after a pretty significant career in the Air Force and Navy. If you ever meet him, ask him to tell you about all of his airplane experiences and different wars, and it's he has very interesting stories. This gets a little bit into our industrial fund, which I'll go into a little bit more deeply. But the industrial fund that we have currently right now is our Industrial Fund 3. Industrial Fund 1 we launched in 2022, Industrial Fund 3 in 2023, and then Industrial Fund 3 in 2025. We, for that fund, are raising $250 to $500 million. And we are currently in our deployment phase. So we are acquiring real estate right now. That we started acquiring real estate into the fund in the beginning in January of 2025. And we continue to acquire real estate pretty consistently. Our acquisitions pipeline is very deep, and we have a lot of properties that we're looking at. At one point in time, 2 quarters ago, we had, I think it was like $100 million worth of real estate that we were deploying within months. So we go pretty deep in our acquisitions pipeline and have a lot of real estate that we're acquiring in the United States. The immediate cash flow is 6 to 8% currently right now. We have a 5-year hold for this fund, and we are looking at a 1.9 to 2.3x gross multiple on invested capital. And this is really what we talk about in terms of what your investment will look like over time. You can expect about a 1.9x multiple, meaning that over the period of your investment, you are going to almost double your money. We are looking at a 17.5 to 19.5 gross IRR with a 60% average portfolio loan to value. And it's actually 8 to 10% preferred return with quarterly distributions. So talking a little bit more about sale leaseback, there's a lot of benefits for the buyer and the seller. And again, to review, what we're doing is we're acquiring real estate from companies that are going to stay in the location where they have built their business. They're not leaving. We're not re-tenanting. We're solely buying their real estate. And really what that's doing is allowing them to redeploy capital back to their business to grow. So instead of getting loans, instead of pouring more money into their business, they're getting that money out of their real estate and pouring it back into their business for a variety of different reasons. Maybe they're paying down debt, adding new line, they're growing in some sort of way, they're building their business, and this is an opportunity for them to partner with us. Benefits for the buyer: it provides a stabilized income producing commercial property, and that's us. New 15 to 25 year institutional quality net lease contracts. We have built-in annual increases. We increase the rent 2 to 3% a year, depending on the property. So that is really what gets turned around, and that's what we distribute to investors. We have tenant financials, so the tenants themselves. Not only do we go very deep into the credit of the tenant, and we look at what their business is, what their trajectory is, over time, how are they going to grow? How are they going to scale? That is, a lot of what we're looking at. I'll get a little bit more into what the credit team looks at specifically later on in this presentation. But what they're doing as well is providing us financial data throughout the whole entire life of the hold. So every quarter they have to submit to us quarterly financials. And then we have cap rate compressions of 50 to 100 bips. The benefits for the seller, why would they do this, right? Like I said, is an alternative form of corporate financing. It releases 100% of the dormant equity from their real estate, and they redeploy it for a lot of different reasons, like I said here, which, expansion, debt retirement, cost improvements. And then on top of that, as I described as well, you have the sale leaseback, and then you have the absolute triple net lease. And so the absolute triple net lease strategy is, immediate cash flow. We purchased below replacement cost. We increase the NOI by building the 2 to 3% annual rent escalations. We have day one yield with bond-like consistency. We really call these investments a bond wrapped in real estate is really, how we describe it. We have a loan structure. So we add loans to these investments. And we select investments with growth-oriented private equity sponsorship of tenants. So about 60% of what we acquire is from private equity groups. And so private equity groups are buying these businesses, but obviously their business strategy is not owning real estate. So we will acquire the real estate from the private equity groups directly from them. So a couple different ways that we buy real estate. Like I said, private equity groups, about 60%. The rest is from brokers that will come to us and sell the real estate that they have from the companies, or the company themselves will come to us directly and sell their real estate. And so if you look here, this chart, what we're looking at is this type of investment strategy versus other different types of U.S. Investments. And so we're looking at, private real estate up in that top left-hand corner, which has lower volatility, higher returns.
Amanda,
next, you're looking at equities. Yep.
Sorry, just very quickly. I just asked people if they knew what sale leaseback was and triple net lease. Let me just explain it just quickly, because there's a couple of people that don't know. So sale leaseback.
Yeah, please do.
Sale leaseback, in simple terms, you've got a business that's running obviously running a business, and they own a factory. And what they want to do is they're getting bought by, let's just use the example Amanda said, a private equity firm. And so the private equity firm is going to own the business, but they don't want to own the property. They don't want to be property managers. So they sell the property. So it's called a sale leaseback. So they sell the property to us. We buy the property and we lease the property back to them. So the business stays on the premises, but it doesn't own the property anymore.
Correct.
Okay, so in simple terms, that's what a sale leaseback is. They sell the property to us, we buy the property, and we lease it back to them. So you've got a tenant in place, and you've got consistency, and you've got predictability. The biggest risk with it is making sure that your tenant can pay the rent, and that's what Amanda was saying with that you've got to do the due diligence on that company and whether that company can survive. So that's the first thing. And then the second part, triple net lease, is if you've got a lease and you've got a house, the chances are you're going to pay the rates and taxes, you're going to pay the water and electricity and a whole bunch of other stuff. In a triple net lease, effectively, you just get the net income. So let's just say your lease is $1,000 a month, you get paid the $1,000. The tenant has to pay for the rates and the taxes and the electricity and the water. There's no deductions that come off it. So just in simple terms, I could get much more complicated, but it's effectively the net return in your pocket.
Exactly. Thank you. I appreciate that. I know I get going on a lot of these and then have to understand, kind of how much more I need to explain. So I appreciate that truly.
No, it's all good.
Back onto this. So, different types of investments in the US, typically private real estate is performing, exponentially better than a lot of these different types of real estate. So we're looking at specifically in the US market. In regard to equities, bonds, commodities, and other types of real estate. This is kind of our step process, and, different asset or different types of ways of looking at this. So, our market focus, we're looking at middle markets, meaning we're looking, not at a very expensive real estate, not very, less inexpensive real estate. We're really looking at like those middle market companies. Typically, the companies that we're acquiring their real estate is going to be about $10 to $20 million, all domestic United States real estate. The property types that we're buying. So, manufacturing, distribution, warehouses, cold storage. Some of the companies that we acquired in Fund 3 right now, the first property that we acquired was called Robin Sports. And Robin Sports is a sport court manufacturer. They manufacture sport courts for the NBA, for, pro teams, all the way down to, somebody's private court in their house. We also have a company called White Plains Linen. It's a linen manufacturer. Like I had said already, in Fund 2, we had a cold storage, we had a lobster processing facility. And so we've had a variety of different companies. Typically, these businesses are going to, make or do something. They're going to manufacture something in the United States. And I'll get a little bit to tariffs, because I know that some people are probably thinking that. But I do have some more information on tariffs and how this is, a shield against inflation and tariffs. Tenant credit, what we're typically looking at is, gross revenue of $50 million. EBITDA margins are over 8%. Debt to EBITDA under 5x. And I'll get a little bit more into what the credit team is looking at in a bit. The lease structure, like what we had said, is the absolute triple net lease, 15 to 25-year lease terms. We are escalating the rent every year, 2 to 3%. So when we come in and acquire the real estate, we don't want to stress the company unnecessarily, because they've been performing well, right? The way that they have structured when they own their real estate. So we don't want to come in and stress the company unnecessarily by adding a really high lease. So we'll add a lease term that is, manageable in terms of payments and price. And then we'll escalate that rent over the course of time. With these types of investments, our hold period of time, like I said, is about 5 to 6 years. And the reason for that, and reason for our long lease term, is that we want to make sure that we sell the real estate so that there's at least 10 years left of the lease, right? So if we have a 20-year lease, we're holding this for 5 years, let's say, then we still have a significant period of time in the lease, because then that company that acquires, or maybe it's purchased by an industrial REIT or somebody else, who is going to buy this property, is going to assume the lease and continue on that lease structure over time. So that is essentially what we're looking at in terms of exits and sales. We are in this portfolio, that Fund 3, we're looking at about 25 to 50 investments. The cap rate that we're buying at, and I'm not sure how much you guys talk about or what you talk about cap rates. Scott, do you talk about cap rates a lot?
I do explain cap rates to everyone.
Okay.
In simple terms, it's a way to value commercial property.
Exactly. And it has kind of an inverse relationship with cap rate and price. Okay. So what we're looking at in the US market right now, in our industrial real estate, in the secondary markets, meaning, again, it's not, it's not a New York City. It's going to be, a city that is just outside, right? So secondary markets outside of a central a city. So we're looking at 7.5 to 8.5 cap rate, which is a really, really good cap rate right now. In 2022, in Fund 1, we were acquiring at about a 6 to 6.5 cap rate. So if you can see that, and then Fund 3 now, what that means is that the cap rates are high, meaning the prices are low. So an inverse relationship between the cap rate and the price, right?
So
low cap rates.
Basically, in simple terms, it means that property is cheaper now than it was 2 years ago.
Yes. The lower the cap rates, when the cap rate is low, like very low, like an Amazon, you'll typically see that those are going to be like a 1 to 3% cap rate. That means that the real estate is very expensive. So, quick little cap rate discussion.
Just one last one. Do you mind just going back one slide? I just want to just show something quickly. So the one thing with the mid-market that you spoke about that we learned years ago, which is very valuable, is you kind of want to get out of the mom and pop. So you want to get out of like what the average kind of investor can do on their own. So you're bigger than the kind of the average retail investor or kind of high net worth, but you're smaller than what the big funds want to look at. So you tend to find the big, the big institutional funds, don't want to get out of bed for deals that are, too small.
Mm-hmm.
And so the mid-market actually provides a great opportunity where you don't actually have a huge amount of demand, and so that you can pick up good deals. And it's been something we've been doing in the US since we started there in 2012. That mid-market is a very sweet spot, basically. So it's outside the noise of retail, but it's below the needs for the big institutions,
Exactly. Perfect. Yep. When I talk about our deal pipeline, we have a continuous deal pipeline, meaning that, excuse me, we're constantly looking at and reviewing opportunities. So our credit team and acquisitions team both work together to review opportunities, to vet those opportunities, and to send LOIs and then eventually close those. And so our deal sourcing, like I had said, we have right now a pretty significant pipeline. I have a pipeline document that I can send to you if you are interested. I can follow up with any information after this call with details, but we do have a significant pipeline for this fund 3 that we are looking at, not only what we've already closed, which is about with multiple properties, I think about 13, and looking at closing significantly more in this upcoming couple months. So we're consistently closing on properties. Like I'd said already, we acquire real estate from industrial brokers. We have great relationships with brokers who come to us directly because we have established in the United States a very a great reputation for this specific type of industrial, single tenant net lease industrial. We really stay very very true to that. We don't chase shiny things and run away and try to do a lot of different other types of asset classes. We really are super solely focused on this industrial. Like I said, private equity groups also come to us directly. We have investment banks and M&A advisors. And really, we have a very selective opportunity pool that, people come to us directly to acquire real estate. We also have a great reputation for closing on deals. That kind of becomes a little difficult, especially over the past, year plus, where it's become a little bit harder to get terms and to get loans from banks. So we typically will go to regional banks and have great relationships with those regional banks and have an ability to close on real estate, which a lot of groups right now are having a hard time, especially with the timeline of lending and all the requirements.
My interest. Where you've got 22 and 3, is that you put in 22 LOIs and you got accepted for 3, or how does that work exactly? Investments under
right here.
Example. Yeah. So what does 22 and 3 mean? Does it mean you've underwritten 22?
If we underwrite 22, then we'll get 3. Let me get you that information because this is from our acquisitions teams. Let me get you. I'll get that information because this chart was updated, so that's interesting. Let me go back and let me get you that one.
No worries.
In terms of debt, like I said, our capital stack, our principals will co-invest. That's very, very important to understand and to know. Our principals are co-investing with you in every single deal that we will do. We also are placing debt, and then investors come in. So our capital stack is just that, right? We're paying down our fixed rate debt over the period of the life of the hold. So we're looking at fixed rate debt. We are looking for at least 5 to 10 year loan terms. 60% is the average portfolio loan to value that we're looking at. And then we'll also look at a blend of 25-year amortization, 30-year amortization, interest only. So, if we can't get those fixed rate debt, then we'll look at other types of loan terms. We try to reduce or eliminate prepayment penalties when we can. And like I had said, we look at regional banks. And typically the regional banks are easier to work with because they know the property or they know the business really well, and so it's easier for us to get those underwritten. And it allows us to be flexible. Like I said, we have a reputation for being able to close. Sometimes if we aren't able to get the loan terms done quickly, we will close in all cash and then back that back out. So we do have, we do what we say, and we say what we're going to do.
Just quickly, Amanda, before you move on there,
Uh-huh.
if there was a question from Ben here, what is the spread between the cap rate and the cost of funding that you're aiming for?
Yeah, that's actually a very good question. So we have a really good chart that I'll send you. I don't think I have this in here anymore, but over time, what we've seen is that we will stay within 200 basis point spread between the debt and the cap rate. And like I said, we have a chart that shows that over the period of time from like fund one to fund three, we've consistently stayed within that spread. So it allows us to be able to still deliver to our investors without getting, overly leveraged. Um, Investment for the risk for our credit review, our capitalization to access. We review industry trends. We evaluate financial profiles. We do a lot of things when we're looking at the credit tenant. We look for unit level financials. There's a lot that our credit team is doing when they're looking at these types of leases. We look at real estate acquisition that's basis points below replacement cost. We have tenant investments in the buildings. We do site visits. Our construction manager will visit every site and review the property itself. And really what he's doing a lot of the time is looking to see what needs to be done on the properties. So we make sure that the properties are maintaining their value in terms of how they look or how they perform. Obviously, these companies want these buildings to stay obviously up to date, and because this is where they're doing their business, right? So we will make sure that we are maintaining that building. If a new roof needs to be put on, then we'll add that into the lease. Or there's a lot of different things that we're doing kind of on the backside to prevent risk. And this is a chart that shows over the life cycle what we're doing. And so right now we are in year 1+ of this current fund. And so what we're doing is acquiring real estate in this 0 to 2 years. Years 2 to 3, you're collecting cash flow. It's important to understand when you invest with us, specifically in this fund or any of our other investments, we start distributing the first quarter of your investment. So if you were to invest today, you would get a prorated distribution for this quarter, and then you would get a full distribution for the following quarter. So you are continuing to get it. It's a cash flowing investment, really. And so we are, consistently distributing, kind of what Scott said. We haven't missed any distributions. We're very proud of that, in that we have, consistently for all of our triple net investments, been able to consistently return distributions regardless of what's happened. There's been a lot of other asset classes that have had some harder times, and industrial is in terms of our structure has not had that experience. So years 2 to 3, you're continuing to receive your distributions. Excuse me. Years 3 to 5, we're going to start thinking about investing exiting. And by year 5 to 6, we are exiting completely out of this. And what that looks like is varied. So we could look at selling each of the properties individually. We could also looking at selling either a portion of the properties as a group sale, or we could sell the whole entire portfolio to, let's say, in an industrial REIT or a larger company or a larger group, private equity group, let's say. Important to say as well here, in terms of returns, and I'll get a little bit more into what the returns look like, but what you're looking at here on exit is that you are receiving distributions on your preferred return. What that amount ends up being, we have a tiered investment depending on how much you invest. And so you're receiving distributions the whole way through. Upon exit, then you'll receive your capital back, and then you'll receive the profits, which is a profit split, like a waterfall. And I'll get a little bit more into that in a second. Again, here, cash flow projections, years 1 and 2, lower returns, and then we'll compound up. And then, year 5, 6, you'll get that exit waterfall, which in this fund is about an 80-20, meaning 80% to investors, 20% to us. Another chart showing that our exit strategies, we have a lot of different scenarios we can look at for exit, which I've already gone through. We could look at, selling each property individually, or we could look at selling them as a portfolio. A little, go back for a second and talk a little bit more about industrial and why now. So I've talked a little bit about the investment. Now a little bit about industrial and the asset class itself. So why are people investing in industrial now? And a lot of that has been, over time, industrial is a solid asset class. A lot of people, believe that they need to know a lot about industrial to invest in it. And it's not necessary. It's just understanding this is just another type of asset class to invest in. Post-COVID, we had a real true bump in industrial and people being aware of the industrial market or wanting to invest in industrial. And a lot of that is because, of the onshoring and reshoring. I live in California. Here in California, we saw all the boats that were holding all of the stuff, right? All of the Amazon goods and all of our imports that were waiting to come in, but didn't have anywhere to go. And so people realized that it was very important to have their goods closer to the place of their business. Their businesses were suffering because they didn't have their stuff here. They didn't have maybe the parts they needed to have. I was remodeling a house at the time, and my all of my like kitchen supplies were all sitting in a boat. So companies realized that they needed to have all of their goods closer to home. What that's done here in the US market is that has created a boom for what we call brand new build industrial, and that's not what we're doing. Because the companies that we are acquiring real estate from have been in business much longer, right? So there are there's a lot of industrial being built here in the United States that is very expensive. And this is causing vacancy rates because a lot of companies like ours don't want to move. They have their building, they've established their business there. They can sell their real estate to us and be able to stay in their place of business in their building, as opposed to going elsewhere and paying much higher prices for this brand new industrial real estate, which is being built. So that's essentially what's happening right now, which is causing, vacancy and a reason for people to want to have these types of sale leaseback and transactions. Our acquisition cap rates remain higher than capital costs. We have opportunities to acquire assets at or below replacement costs. So it's positive leverage, healthy yield spreads from day one. So, from day one, with the business being in place, already being established, we have, a fully performing tenant from day one, and we have, a cash flow that's already securitized and yielding. So a little bit about what's happening right now.
Awesome. Thank you.
This is a little bit more about the industrial market here in the US. So rising price per square foot right now is happening. And like I said, that's a lot of it because of these new industrial businesses or new industrial buildings that are being built. We have very low vacancy all throughout the United States. We have strong leasing activity. So We have a lot of companies that want to lease and are, looking for opportunities to lease. Um, and industrial itself, if you look at this, bottom middle chart, we're looking at industrial versus all other property types, and industrial is outperforming, obviously. And then we have some positive net absorption. So, when we look at industrial as an asset class compared to other asset classes, industrial is a very high demand asset class. And we have a manufacturing vacancy at or around 3.5% in the U.S., and leasing remains near historic levels.
Just in my interest, do you see that as an asset class, as a trend, industrial remaining with strong demand?
We do. We had a white paper that we published. I could send that to you as well. We published it a couple of years ago, but really, it all is still the same. What we had anticipated at the time was, at least another 5 to 10 years plus of industrial being a strong market. Really, honestly, with the amount of properties in our pipeline, I would venture to say it's probably even better than what we had anticipated. Especially, like I said, with the vacancy, with the prices rising, there's just so much new construction. Like I said, I live in California, and so a lot of the new construction is here in California, where prices are high as well, right? And so, these buildings are going up all the time, and really, causing a lot of these businesses to want to stay, obviously, in their where they are, and just to continue building. And really, what ends up happening as well is that it becomes an opportunity, an additional opportunity for us, because with them staying in their location, they have a lot of property, right? A lot of space and a lot of land that is adjoining their property. And so what ends up happening is that a lot of times they will, pay down debt and improve their business so significantly that it becomes an opportunity for us to build onto that property. And we've done this a number of times. We have a construction manager on staff who can look over and, can go and do these projects. We have a couple right now that we're in the process of, but we are able to add on square footage, which then essentially increases the value of the real estate. So there's so many great opportunities for us to grow, in our space, in our place, without having to have these companies go in and pay more price per square foot for a new build.
Quick question, Amanda. Ben's asking here, are you seeing that the newly built property rentals are pulling the older property rentals up as well?
You mean the prices are going up?
Yeah, so so effectively, I think the question is, if you take newly built properties, are they the property rentals, are they pulling up the older property rentals? So if you've got a new building and an old building, are the new building rentals pulling up the old building rentals?
In terms of price, we try to maintain our price pretty consistently, right? We don't try to go too high, but I think overall in the market, obviously we're benefiting from the new construction. And the lease, obviously, the low vacancy is still a really big deal here in the United States.
Cool. Okay. Excellent. Thank you.
So here's where we get into some of this inflation, interest rate, tariffs, and I heard a bit from the previous, just about some of the trends here in the U.S., and obviously tariffs is one of them. So not something we can't talk about, but we have. With these types of investments, what we're looking at is a hedge against inflation. And the reason being is that with a net lease structure, in terms of inflation, the business itself has already been paying for all of these types of utilities, right? And so they literally continue paying on what they've already been paying on their taxes and their insurance and their expenses, and all of their everything they need to pay for. So we have, in an inflationary environment, but we have for ourselves a shield against inflation, because we are not having to then pay all of these types of expenses and pass those on to our investors, right? We also have predictable NOI growth through those 2 to 3% annual rent escalations. So we know when we're going into this investment, our investors know, what is that rent escalation going to be? What is the price of the rent? What is that going to go up to? And we can consistently be able to say over the life of the hold, we are going to be able to grow this rent to this certain percentage, right? And the business itself already knows, they already have that written into their business plan. The debt and interest rates environment. Interest rates have risen, over the past few years. When we were, in fund one, the interest rates were much lower, and our cap rates were along with that, right? They were lower. And so right now what we're seeing is that, and what we've already discussed, we really stay within that 200 basis point spread between fixed rate debt and our cap rates. So that is really consistent. And our credit team will stay very.
So can we just explain that in English for everyone? So
Yeah,
when you say 200 basis points, what's that basically saying is that where Amanda was saying they're buying a property at a 7.5% cap rate, basically what she's saying is that we don't want to be borrowing more than 2%. So 200 basis points, 2%. Beyond that cap rate. So effectively what you're saying is that you would borrow what, between 5.5% and 7.5%. Is that what you're saying?
Yep. Yes. Yeah. And then our like I said, the chart that we have is very interesting that we've stayed within that. And then like I said, that means that we are able to continue to distribute, continue to grow NOI. We're not over leveraging ourselves. Yeah. And then in terms of tariffs, the companies that we are acquiring real estate are all U.S. manufacturing. And to be very honest with you, a majority of these companies have, pretty much all of the companies are not acquiring goods that are being tariffed. So they have minimal exposure to overseas supply chains. They have, like I had said at the beginning, they've gone through a lot of cyclical downturns, and they have a history of controlling their costs. So that's a lot of what our credit team will look at pretty deeply is these types of things, especially in this tariff environment right now. And so, the intention of the tariffs is to drive demand for domestic manufacturing. And really that it grows industrial real estate in the United States, and draws companies to want to build and to have an industrial business here in the U.S. And that's kind of what we're looking at right now.
Just a quick question before you move on.
Yeah.
Ben asked a question again. Ben runs a big property fund, so he's
I love it. Yeah.
Of how this all works, but a real estate fund, to use your language. But he said, what are the thoughts on interest only versus amortization and interest only with the aim to maximize investor distributions?
Yeah, we'll look at interest only, but we really are more focused on the fixed rate so that we can hold those rates over the period of our hold time, right? If we need to look at IO or amortization or any of these other lending terms, we will if we need to, but we are really mainly focused on fixed rate debt and trying to find fixed rate debt.
Okay. And how did you cope? Because I find it interesting, the majority of our sponsors either reduced the distributions and or had to stop the distributions because interest rates went up. How did you guys, was it because most of your debt was fixed that it didn't impact you as badly?
Yeah, exactly. Yep. Yeah, our fixed, that's why we look at fixed rate debt, really. And a lot of the funds or the other types of investments were having a hard time because, let's say in multifamily, they had, short-term debt for improvements and CapEx. And they ran up against that because, building times and costs raised. So, those types of investments got hit because of that. We're not doing, CapEx work on that. So, with these types of investments, like I said, it's cash flowing, it's consistent. We continue to distribute as long as we have those 2 to 3% rent bumps, which is expected. And as long as our tenants stay in place, right? We're distributing to investors because, we're not over leveraging ourselves. We're not getting in. We don't have the need for, short-term debt or any types of other types of, riskier debt. So we really, it's very consistent. It's very conservative. And like I said, it's just cash flowing.
Perfect. Thank you.
So this is our a look at our industrial funds 1, 2, and 3. Like I said, industrial fund we acquired and started acquiring properties in June 2022. We had 24 properties total. We had $60 million in total equity. We had in this fund, we had targeted $50 million. It was a different time and it was really exciting. We started raising in June 2022, and by mid-August 2022, we had raised $50 million. So it was very quick, we had done these deals, all the single tenant net lease industrial prior. We had all sold those to investors single asset. So every single one was sold individually, meaning, for investors, they were able to invest in them individually. And so what ended up happening is that a lot of investors weren't able to get in because the investment became so popular that people were jumping in and investing before others could get in. So we realized that we had, enough demand and enough of an acquisitions pipeline to have a fund, which is again why we opened this fund. So the fund, people were anticipating the fund, and we had raised really quickly, and then it kept the fund open for investors for another 2 weeks, and then raised $60 million. So by the end of August, we had raised completely. We acquired properties all the way through December, and then completely closed that fund by December 2022. We opened Fund 3 actually in February 2023, started acquiring properties in March. And then we acquired 18 properties in that fund. We raised about $80 million in that fund. If you can look there at the cash on cash yield for that one right there, Fund 1, we're averaging 6.89, Fund 2, 7.39, and that's current. We have had, like I said, consistent distributions since, the start of both funds. We see the target net IRR down there. For this one right here, we just, opened Fund 3, really acquiring real estate in January 2025. That was when we had acquired our first property. And we have 11 properties total, with some having multiple locations in those. And we have raised $80 million since August, which that's more now.
What's the target there you're trying to target?
Are you talking about for closing for investors?
Well, you've raised 80 million. What was the target that you were looking to for the fund?
We're targeting $200 million. So we're still raising. Yeah, we still have a lot. We still have a lot to go. We probably will be closing, I would anticipate within the next couple quarters, to investors. And because let me go back, because we are rolling, we have rolling closes. We've been closing consistently the whole time. So we by the time we close to investors, we will have acquired probably if not almost all of the properties that we have in our acquisitions pipeline. And I have the acquisitions pipeline in a separate document that I could send if anybody's interested.
Yeah, and I think a couple of people have said they are, so if you could share it with me.
Yeah, for sure. Definitely. Most definitely, for sure. This right here, our approach to credit and risk. And so, this is some details on our credit model. Our credit team has a very specific credit model and standards that they look at when they are acquiring real estate and when they have risk metrics, and those get very detailed, and they have a pretty specific benchmarks that they need these businesses to live within. And so, a lot of this, on the right-hand side is kind of what they're looking at, in addition to a lot of other really detailed data. They look a lot at qualitative and quantitative data. They are really, really vetting out the business, making sure that the business is not only, successful now, but will be continuing to grow and grow in success over the life of the hold. We essentially want the business to be more successful when we sell than it is obviously when we buy, so that when we sell that lease term, when we sell the property along with the lease, then the business itself is booming more than when we acquired it, so that we can sell it for obviously, more money. And so here's a little bit more about our approach to credit and risks. And so this is from our credit team, and what they're looking at specifically. The years in operation, they have to be in business, much longer than 10 years. We want companies that are very established and have been in business for a long time. We want them to have customer diversification. Excuse me. We look at the ownership, who are they owned by? Is it, are they family owned? A lot of them are family owned, or if they were family owned, they've now some have, sold to private equity groups. And what does that look like? What is that private equity group? And we have a lot of private equity groups, like I said, that will come to us directly, and we work with, very well with private equity groups, some specifically. And so they continue to want to work with us and sell us real estate. We look at revenue size, revenue trends over periods of time. We look at EBITDA margins, net leverage. We look at leverage trends, current ratio, fixed charge. So they're looking, like I said, at some not only qualitative but quantitative data. We have competitors. A lot of these companies are, like Scott had said earlier, very institutional. We are not. So we are private. We're not, public, and the middle market is really, where our sweet spot is. And so you can see kind of like where some of these businesses are investing, but it's. There is a lot of people that are looking at industrial, but just obviously approaching that business or those funds in a different way. It's important as well, and I appreciate that Scott has vouched for us and said very nice things, but I always talk to investors and talk about the need for them to trust their sponsors and to trust the investment group. And that's what we work really hard to build trust and to build, a track record that is consistent and that we, do right by our investors. And that is a really a very, very important point that I want to make sure that I get across.
That's why track record.
We have a lot of partners.
Sorry, just quickly. That's why track record is so important. Because we've done multiple deals with you, so I can speak from my experience, not from what are we just seeing on a PowerPoint.
Yeah, for sure. It's important to point out as well, we have a lot of institutional partners. Excuse me. Fidelity and Schwab. Out of all of these, in our funds, starting with Fund 2 and now Fund 3, we have Fidelity and Schwab. We are on their platform, so it's a long process. We're working on some of these other ones, but investors with Fidelity and Schwab investment accounts can invest directly into Fund 3 from their Fidelity and Schwab accounts. Otherwise, if you have any other retirement funds, then those need to be self-directed, which allows you to then direct where you want your retirement funds to be invested into. But Fidelity and Schwab, we do have a relationship where investors can directly invest from there. And this is a case study, shows a fully realized building that our investment that we had previously. So this shows our track record. So Cameron Ashley was a business that we acquired from another company, and so we acquired this property, put a sale lease back, all absolute triple net leases. The price of that was $16,500,000, which is $51.43 a square foot. That was back in 2018. So that was, quite a while ago. You can see the rents that we placed on that, and the cap rate was 8.48%. And so this one right here was 3 industrial properties in Texas. The lease terms were 20 years. We had 2.25% annual rent escalations, and we had absolute triple net lease. So the investment went full term. We had a private equity sponsor that improved the credit quality, and then we exited within 3.5 years. The portfolio was sold. Investors received a 1.9x multiple, and it ended up being a 21.9% IRR. And you notice we had originally anticipated a 15 or 17% IRR. So this one we had gone over, 18 to 19% IRR. So we had gone over expectations for that one, and then exited with a $26 million with a 5.75 cap rate. So you can see kind of what we're looking at achieving over time is obviously selling for a higher price, lower cap rate. We are anticipating or are trying to obviously deliver to our investors a much higher return than what we anticipate. We always are very conservative in our estimates so that we can over deliver typically at the end.
Could I ask a quick question?
Yeah.
Paula asked a question which is useful. Obviously, this was a deal that really worked. So we can go through the deals, but she did say, hey, would you mind just talking about one that necessarily didn't work as much so that
Good
you
question.
can understand the risks,
This is it. This is the one that didn't work. So
we didn't plan this for the record.
I know. This is okay. So this was a unique situation. It was a company called 4Arrow. We had acquired the company in 2020. What ended up happening was a terrible situation. In 2021, post-COVID, the company received faulty parts, unfortunately, and those parts went into a helicopter, which ended up crashing, and that helicopter crash resulted in death. So the company themselves had to go into bankruptcy protection, actually go into bankruptcy. And what ended up happening is that we were able to, because we owned the real estate, we were able to pull the real estate out of bankruptcy, and we were able to sell the real estate and still deliver to our investors a double-digit return. So that's really important to understand as well, is, when people talk about risks and they talk about, what are the risks? Well, this is it, right? The business wasn't able to stay in the property. We have the real estate as our leverage, right? So we were able to get the real estate out of bankruptcy. We were able to return to our investors a double-digit return. It was a 10.2% net IRR. I think we had anticipated 15 to 17%. So investors didn't get as much as they had anticipated originally, but we had delivered, at least a double-digit return to them. And to be very honest, a majority of these investors continue to invest with us. They appreciated the way that we communicated, that we, really went to work for them and to make sure that our worst case scenario didn't become our worst case scenario, right? So this is our worst case scenario.
And I think the point being, and I appreciate you having this, Amanda, because when it comes to investing, it doesn't always work. There's no ways. If everyone told you that every deal worked, they'd be lying, cheating, or stealing. So, but I think for me, what becomes so important is how the partner behaves. There's 2 things that you just said there that are really important. One is how the partner behaves to be proactive and fix the problem, and secondly, how they communicate, because some partners bury their head in the sand, and that's a nightmare.
Yeah. And it's also important to point out here on the outcomes in Q1 2022 that we never missed a single debt payment. So we definitely didn't, put our head in the sand and try to hide from the situation. It was terribly unfortunate. And as a result, like I said, a majority of investors stayed with us and continued to invest. Um, I want to kind of pivot for a second to an additional investment. And when we talk about our pipeline, we have a pipeline, which is, the properties that are going into our fund three, but then we also have a pipeline of different types of investments that we can offer to you as an investor. Braniff Park is one of those that we have available right now. In addition to the fund, in addition to the Evergreen Fund, which I had kind of teased a little bit, and I don't have specific information about that yet, but I will soon because we're probably going to launch that in the next, quarter or so. Braniff Park, in this is just a couple slides. I have a full OM for you that I can email to you. Scott, I sent that
Yeah.
to you. I don't know if you wanted to distribute that to
Yeah.
everybody
So we're
or how
going
you want
to,
to do that.
so Paolo's working with your team and whatever to get it. What the intention is to have this live on the platform so that people will be able to
Perfect. Okay.
participate
Excellent.
on the platform. So all the information will be on the platform as usual. Everything will be on the platform.
Yeah. So I wanted to add in a couple different slides just to give you a preview of what this looks like. It's an additional industrial strategy that we started this past year. So in January, we partnered with an operator. His name is Scott Word, and he's been in the multi-tenant industrial space for quite a long time. We wanted to get into multi-tenant industrial, which is a little bit different than the industrial single tenant net lease industrial. Multi-tenant industrial has more of a value add component to it. So when you're looking at our single tenant net lease industrial, we're not leaving, we're not re-tenanting. We're not having to do the CapEx improvements on the property itself. The tenant is responsible for those, right? And this multi-tenant industrial, it's different. So we do have a CapEx, we do have a value add. We are having to re-tenant. So that's the difference between that type of investment versus our other main fund, industrial investment.
Can I
So
just,
Braniff Park,
sorry, Amanda, sorry. Do you mind if I just put into English what I just heard for everyone? So
yes, please do.
in simple terms, when you got the sell and lease back, remember that they're buying the property, but the tenant is effectively staying, the company's staying as the tenant in the property. So you don't, there's no vacancy, you don't have to kind of lease out more space, et cetera, et cetera.
Yeah.
So it's pretty stock standard. Obviously, the risk is slightly higher because you've got one tenant, one income stream, which is why you need to do the due diligence. In a
Yep.
multi-tenant, what she's saying is that now you've got an industrial park with lots of different tenants. And so here it's a value add, which basically means that you're buying a building and you're increasing the value by either putting the rents up and or filling the space that is vacant. And so that's why it's value add. Now, this, again, from a risk perspective, there's a pro and a con. The pro is that now you've got multi-tenants, so your income is distributed or diversified across a number of different tenants. The con is that with a value add, there's an execution risk, which is why you've got to have the right partners to be able to fill up the tenant. So sorry, I hope that helps. I just wanted to kind of
No, that does help. And I only added a couple slides here because the OM that will be shared will have all of the information. I just wanted to briefly discuss, what this investment is. What we're looking at is a 2-year hold period. So it's a shorter timeline. We are looking at a $75,000 minimum investment with accredited investors. And then your multiple over that 2 years is 1.35x. You have quarterly distributions. Our average cash on cash is 7.5%. And so with this investment, I think I added another slide with, we have a location in Tulsa, Oklahoma, which is a secondary market in Oklahoma, but it is very close to the Tulsa International Airport. And it's very close to the I-44 corridor, which is a main corridor going through the state of Texas and into, down towards shipping. So we have in-place rents. We do have a lot of companies, a lot of businesses that are they're in this, the property itself. But we have rents that are around 20% below current market levels. So we need to get those rents up. And then we have triple net leases that are going to provide a hedge against inflation. We need to lease up. So we have vacancies currently right now. So we need to lease those up. We already have.
What is the percentage vacancy? So what is your occupancy at the moment?
Yeah, so currently right now, I think it's over 80% is leased up. So we still have a significant amount that we still need to lease up. We have already leased pretty consistently over time. I need to see how many more we have right now, but we are leasing pretty consistently. But we do have kind of those remaining to do. A majority of what we're going to do on here is value add. So the business, the property itself, is a little bit older. When you see the pictures of it, you'll see that, it just needs kind of a facelift. We need to do some, upgraded paint and signage and parking lot enhancements and lighting and landscaping and rebranding and kind of just that curb appeal that the property itself really needs in order for us to be able to sell it at a profit later on. We also have
curb appeal just means making it look pretty. So
yes, exactly.
When you stand on the curb, it looks nice from the outside.
Yeah, when you just look at it, it looks pretty. Right now, it has it just looks very, very dated. So that's what we are going to be doing. We also have around 4 acres of excess land that we're going to lease as outdoor storage. That's additional revenue that we're going to generate from just this, excess land that's sitting there right now. We have strong appraisals currently right now, and like I said, we've partnered with Scott to create Sword, which is, our multi-tenant industrial strategy. We have already had 3 different investments over in 2025, all that have been and are continuing to consistently distribute to investors and to grow and to profit. So we feel like it's a great strategy and a great benefit add-on to our single tenant net lease strategy. And to wrap up, this is our picture of some of our principals. Excuse me. You have contact information. This right here is my contact information. So please, take that information, and I can provide to you any documents. Scott also can, get you any information or any documentation that you need from us. And that is about it.
Awesome, Amanda. Well, listen, thanks so much for that. It was very, very comprehensive. So I really, really appreciated it in terms of the overall process. Just in terms of the documentation, I know that Neil and Paula and yourself have already met, and he's trying to, get it up on the platform, etc. So I'll let everyone know as soon as we got it up and live and the documentation and everything so that we can share it. The other thing was, you mentioned a couple of things that I wrote down here that you were going to share with me. So one was the acquisition document pipeline.
Okay.
One was the white paper on industrial. And if you wouldn't mind, you can say no, if your PowerPoint, if you would mind sharing that with me, I can PDF it and I'll put it under the recording so that people can look at it if they want to, if that's possible.
Yeah, that's perfect. I can do that. And then the Braniff Park will be posted on your site, correct?
Yeah. So we'll put that up on the platform. I know there's quite a tight timescale in terms of closing, so we're fully aware of that timescale. And I mean, there are, for those of you who haven't filled in the survey, you'll see in the survey I did just put up a thing if people are interested in the industrial opportunity. Because like always, and I think everyone's starting to learn now how it works, when these deals become available, they don't last for a long time. There's not a long time until they close, etc. So it's again trying to give people an idea of the pipeline. And I think for me, there's some kind words coming through for you, Amanda. But I think for me, the aim from today, which I think you did a remarkable job, so firstly, well done, was really 3 things. One is who is Mag, and why, why can someone work with them and trust them? And I think, my takeaway on that was you guys have a 10-year plus track record. You've got an IRR in the region of 17.5% across $1.5 billion in investments. It's quite a substantial track record. And we personally have done 3 deals with you, 2 of which are currently live and 1 of which we've exited, and everyone got their money. So that for me is track record. The second thing was the industrial, and you explained the industrial market, why it's been robust, why it's been resilient, and specifically what's happened since COVID, including even the tariffs, which, by the way, there is quite a lot of talk that with all the tariffs, there's $8 trillion of investment going into America, which is having a dramatic impact on industrial logistics and very much the space that we're in. And then the third is that you've given people an idea of pipeline. And, yes, there's the one deal, the Banff deal that's available. Am I pronouncing it right? But anyway, the Bramwell, I don't know how to pronounce it, but anyway. Brandon, deal that's available sort of now, and we're going to get that up on the platform ideally in the next, hopefully this week. But obviously you've given us the pipeline of some of the other deals coming down the pipeline, which hopefully everyone can get a sense of what they can expect in 2026.
Yeah, in terms of timing, that's a really good point. So like an investment like the fund, you have more time to do due diligence and invest, right? So because we have that timeline open for multiple years, or at least a year and a half, then there's more time to do due diligence. And I think these kind of calls are really good because then you get to meet us and get to know us. And if you want to have, individual calls with me or ask any specific questions, I'm happy to do that as well. These types of investments like Braniff, we have a timeline because we're closing the real estate, right? So we have to get investors in, collect funds, and then be able to close with you as our partner in the investment. And so that is when the investment itself, the timeline gets a little tighter. And then, due diligence just needs to be done quicker. Questions, like I said, I'm happy to answer any questions that anybody has about any of our investments, whether that be, via email or a phone call, or, getting on and doing another one of these calls just to go through the investment itself. So Braniff does have a timeline. We are closing at the end of the month. So
yeah. No, we're fully aware of that.
And I've held some back for you guys just in case, just because I knew that we had this call and I wanted to make sure that I was able to.
There's already demand just from the people that we tend to have. Sort of 1/3 of people are here and people watch the recording, and etc. So there's already demand in terms of that process. I think I just want to acknowledge you as well. It's nearly 1 o'clock in the morning Californian time, so thank you very much for helping. Because obviously we've got people in Australia and England and Europe and South Africa and Africa and Asia, and so it's really hard to find a time that suits everyone. So really appreciate you. And I just wanted to finish. It's a little game that we do every time, and so what did everyone think of the session? Let's have some fun. 1 or 2 words. Get ready to post in the chat. 3, 2, 1. Okay, go for it. What did you think of the session? Let's give Amanda a little bit of a sense of your experience. But I can see there we got magnificent, spelled capital MAG-nificent.
Oh, I like that. See, I saw what you did there. I like it.
Well done on concise, comprehensive presentation. Amanda is great. Mag sound consistent and reliable. Ben had a question here. Does the multiple 1,35 plus include the quarterly 7.5% payments?
Yeah, so the multiple on invested capital is by the end. So by the end, you're with the return of capital and everything, that's the exit multiple you expect.
Yeah, so effectively the multiple takes into account the income plus the capital growth.
Yep.
Safina said, thank you, Amanda. Appreciate you doing this. What do we got here? Thanks, Amanda, for the insightful presentation. Very interesting. Thank you once again. Amazing, awesome, magnificent, interesting, great, fabulous. Thank you. Great insight, insightful, incredible, insightful, great, informative, super incredible, extremely informative, great insights. I think
I just need you guys to make me feel good about myself, especially at 1 a.m. I appreciate it. Well, listen, I know. And then I have I'm gonna get to bed. I have a conference also today, so I
Well,
still
I
have
think
a busy day ahead of me.
no, well, I think let's firstly, really, really appreciate your time, and please go and get some sleep. I don't want to keep you up any later.
Thank you all. I appreciate your time, and it was really nice to meet you. And I look forward to speaking to you and continuing our conversation.
Awesome. Thanks, Amanda. Have a lovely day.
All right.
Well,
Thank you.
sleep and then day, but
Well, I know. I don't even know what time it is anymore. All right. I'll talk to you.
cheers,
Bye bye.
bye.
Thank you.